So I'm going to talk a few minutes about the corporate side and flipping over and just what it is you need to do over the next few months. One of the things that we encourage clients to really look at in the next 45 days or so here of the year is really what can you do to boost revenue? Are there deals you can run out and cut with people right at the end of the year? Maybe you have customers who are still needing to use, some of their budgeted dollars, or for them, it's a tax benefit, to go and spend money with your company. So it's something to look at to try and see if you can really kick it in gear, because a lot of people don't think about that, and it's a chance to get somebody's attention. And then also just managing your expenses. Back to what Nancy was talking about earlier in terms of, do we go ahead and prepay something, to take the deduction of your cash basis? What do you need to do? We do a lot of that kind of planning. We have a lot of clients at this time of the year that we encourage them to do the same thing. Go out, buy the equipment you need for the next 6-9 months. Let's front end load it. Let's take an immediate tax write-off for it. But for book purposes, we're actually going to depreciate it over the next 36 months. We'll get the bank to basically arrange for you basically an equipment term note that matches that in 36 monthly payments, makes it all work for you. But again, you've been able to buy what you needed to operate your company and get the tax benefit both. Those are things that over the next 45 days or so that really need to be looked at, just making sure you don't let benefits or opportunities pass by.
Can I add something?
Sure. And by the way, this I didn't introduce Simon. Simon Martin is the managing director of our investment banking group, White Rock Advisors. So he handles that other whole side of corporate finance and structure.
So when we look at it, and we look at the number of baby boomers, we see a significant amount of small and medium-sized businesses that are going to change hands. The business owner, their net worth is tied up in the business, and in order to get that value of what they've created, they're going to have to exit. They're going to have to sell. And so when you're looking at planning, if that's something that's on the horizon, it might differ from tax planning. You might not want to defer revenue. You might not want to reduce your taxable income, because when you go out and market your business, the purchaser of your business is going to pay you a multiple of your trailing earnings. So the planning changes in terms of how do we maximize our earnings in this period so that we get the highest exit and sales price. So you just have to know what your plans are going forward with your business, how you're going to plan at the end of the year. Are you trying to reduce your taxable income, or are you trying to increase your earnings because you're looking at potentially exiting? So
exactly. And it may be that you can accomplish both, by sitting down. One of the great things that our firm does for our clients is, you hear us talking this morning, we're able to bring the whole financial reporting, the investment banking, the tax, and the investments all in a room together for you at one time. And that's really our commercial that we bring to the world, is that we can bring that. We're one of the few people in this region in the United States that can bring all those people into a room with you in just a few minutes, get on a whiteboard and talk about all the topics. So as you're trying to work your way through these different issues, you at least can make decisions that we can mathematically and tax-wise and otherwise help you understand what happens. Some other things to think about, and this kind of goes to what Simon's talking about too, is bonuses. How do you record things? What do you do? Are they going to be add backs that we get to use whenever we're looking at valuations? And that's something we do a lot with people, is what are the one-offs that you've had during the year, and how do we isolate and document those? 401k match for people. Do you want to do that? Is that a way of both rewarding employees at the same time reducing taxable income?
And it doesn't have to be made before year end either.
Right.
So,
what is the timing for that? I don't remember.
when you file your before you file your tax return.
Yeah. So it truly is a deduction that you can take, that you can get, but you don't have to actually turn loose the cash for a number of months that way. And that is the other thing I think that's in that supplemental, is all the tax deadlines and stuff have shifted, okay, in terms of when things have to be filed. I say all, that's probably not true, but there's been some major shifts in there. So we stuck that in the package for you so you'd know, because that's another major change that's taken place this year.
It actually doesn't. It actually doesn't take place until the filing for years after that start after December 31st, 2015. So
Yep.
it'll be for next filing season, but just foretelling of things to come.
Another thing to think about, and we're already having these discussions with our clients, is what do you need to do with physical inventory? What kind of count? What do you need to have for reporting purposes? Even just going out and making sure that somebody's looked at all the CapEx. If you have rolling assets or you have different locations, we have clients who operate in all 50 states and even some foreign countries. Just making sure that someone has gone out and taken a look at what's there and making sure that things have not walked away or inadvertently disappeared that are going to pop up during the audit process, stuff like that, that we know where the inventory is, that we can tie those things down. If you have an audit firm or someone who's reporting on your numbers, making sure that you include them in that process. So maybe perhaps, and even if you're thinking about an audit in the future, a lot of people don't realize that you really have to bookend it. So you have to have done the audit, the actual inventory observation the year prior, as well as the year in you need audited, so you can determine what cost of goods sold was and how much change and roll there was in the inventory. Someone has to test that, come out, look at your processes, procedures. So we encourage clients to look at that. We like to try and time those, and they can be done a little before year end, a little after year end. So you're not having to call your people in on December 31st, to actually do an inventory observation. Also, accounts receivable reserve, just looking at that. What do you have? What do you want to really take a write-off for? What do you want to reserve? And again, for tax purposes and for book. And then last but not least, it's just collections. What can you do to go collect some dollars from people prior to the end of the year, which allows you to help offset against that reserve? And maybe you're discounting it some, but you're getting the cash in the door and getting it off the books. Now we're moving on to just goals. One of the things we encourage people is going back and looking at 2015. What goals did you make? Did you make them? What problems did you have? What issues are out there? And then beginning to look forward already at what do we want revenue for 2016 to look like, as well as profits. What kind of marketing dollars do we want to budget? What kind of advertising expense? One of the places that we see a lot of changes taking place are how our clients deal with advertising and sales and marketing in today's digital and social media world. We just were involved in the sale of a company that is in the digital media world and stuff. Very different type process of terms of capturing data and information and buyers' habits and these types of things. It would not have even existed 5 years ago. It's all new technology. So the costs that go along with those when you're spending those dollars may be very different too in terms of what you're going to do and how you're going to spend those dollars. Technology. Well, what are you going to do there? How do you stay up on that edge in terms of what's happening? Is it cloud? Is it new software? Is it just software upgrades and updates? Planning for all of that, as well as any other innovation. We see a lot of clients today that are struggling to keep up, and our comment to them is always plan for the fact that every 36 months you're going to, for instance, change out probably most of your hardware nowadays. If you don't, you're so far behind the curve until the cost isn't an incremental issue at that point. It's a very large issue to try and get through in finance. So you have to stay up with the software that changes. You don't want to be on the bleeding edge, but you certainly want to be following that on a leading edge type thought process. And then looking at risk management. This kind of goes with, this is the corporate side of the insurance that Chris talked about. Reviewing and looking at your coverage. Do you have business interruption? We got into this discussion with some of our software people recently with dealing with the cloud, with what happens if something happens in the United States and you can't access the cloud. What happens if, we all just take it for granted that cell phones work, that everything happens. Having been through a hurricane in the last 10 years and watched everything just absolutely shut down, you cannot imagine how lost you feel and that catastrophic cost to businesses. New Orleans was a great example of what happened, and people need to be thinking about what those potential issues could be and how you basically insure yourself around that. Earthquake insurance. Who would have ever thought in Dallas-Fort Worth that we would hear about that? I actually was able to get, for $100 a year, earthquake insurance on my home here in Dallas. It's easy to get. All you got to do is ask. Do you have new locations? If, for instance, if you ended up in the Dakotas in the oil business, we have clients in all types of businesses that are moving around and opening in other markets besides Dallas as they're beginning to spread. Do you have directors D&O coverage for things that would actually, in the event of some type of litigation, cover your directors and officers with anything they were held liable for either not doing or doing? Looking at that. Same with E&O. If there's an error, something doesn't work, and there's some kind of problem. And then new entities, just making sure you do that you're thinking about new entities we form, have they been put on the corporate policy underneath the coverage? And then new services and products. We all get so involved in some of the stuff we just forget about, coming back and cleaning up some of these pieces. One of the other things that had run along when we were talking about earthquakes and stuff, we recently, in closing transactions now, when reps and warranties are done in a transaction, you can actually insure reps and warranties as part of a transactional cost now. So whenever something's done and there's actually a sale of a company, there's going to be some reps and warranties. It's another thing to think about out there in terms of coverage.
As you say, one new coverage area for many of our clients is cybersecurity.
Yeah. Right. And that's not going to get any better. I mean, it's another, I laugh and tell people, it used to be that people would kick your front door in and come in to steal from you or something or break into your business. Nowadays, they come in through the wires and they come in through all the Wi-Fi and all the systems and, just the exposure. For somebody like us, and most other companies, but we have Social Security numbers. We have all types of financial data. We have all these different things we have to think about in terms of what we hold and have and how we not only try and make sure that that information isn't ever exposed, but where's it redundantly backed up in several other different locations. It goes back to the technology and the innovation. And that's why we were having the discussion about the cloud versus servers, and then it's a cost versus benefit. And I would encourage you, look at those things. I mean, there are decisions to be made there. I laugh, tell people, you're going to make a decision when you decide not to deal with something, okay? I was mentioning to somebody outside earlier that we were at Tate Lecture Series last night, and there was a gentleman speaking about the hidden brain. And one of the things he talked about was that we as human beings, and when we all think about it, you're going to laugh, we don't like bad news. How about that? And so consequently, we will adversarially go away. And he was using statistics and studies that they had done where even if you would tell someone, if you will have a test, I can guarantee I can cure your cancer, people would say, no, I don't want the test because I don't want the potential bad news. That's hard for me to get my head wrapped around. 40% of the people chose that. And so it's interesting how we sometimes as business leaders and management and business owners and family leaders have to basically force things to be looked at and dealt with. I know we deal with it a lot with just simple mortality issues with clients. People who don't want to deal with estate planning or what's going to happen to my company if I'm not there. And back to Simon's comment about the reason a lot of boomers are walking in our doors and asking, what do I do with my company? How do I sell this? I always laugh. It all starts, if you drill down, with pillow talk with mama. That she's like, if you die tomorrow and all of our net worth's tied up over there, what do I do? How do I live? I don't know how to run that. The kids have gone this way and the company's gone that way. That's all part of that big wrapper that has to go around all these different issues with insurance, life insurance, estate planning and stuff. And it's overwhelming to people to think about that, but that's what advisors and people like us are there, is to try and drill down to that and get it down to something that's a workable process plan over a period of 6 months, a year, 2 years. Because a lot of cases we spend, 2 years, maybe getting people ready to do a transaction even, just because you've got to work through all these different issues. Cash flow, the important. This is the blood of the business and the lifeblood that goes every day. Our suggestion is that people run at least 18 months. You need to get past the 12-month period you're looking at. Really take a hard look at your cash needs. It goes back to the budgeting areas. What are you going to spend money on? The technology, all the different changes, the growth, and the goals and expansion that you have. Then just the CapEx. What is it you're going to need? and the new hires, and the new markets, new products. In today's environment, we're finding that there are a lot of, if you need new people in the Dallas market, labor market, you can't find them. You're going to have to pay recruiting fees. You're going to spend 25 to 30% of first year's comp to replace somebody or to hire new people. It's not that way all across the U.S., but it is in Dallas. And so if you're spending most of your time in this market and your main infrastructure of your company is here, it's just a more difficult market to work in. So growth and those kinds of things are expensive. You have to look at that. Lender discussions. We encourage people, be proactive about this. Go sit down and talk about, do we need to modify? We met with a client last week, and I was so proud of them that they had already sat down and gone through the process of what are we going to do next year. It takes 60, 90 days typically to get through all the paperwork and stuff to get your lines renewed, modified, through committees, those kinds of things. So it's not something, if you run into a cash problem, unless you have a lot of extra room on your line and things like that you can get fixed quickly. So you just need to look at that and be thinking ahead as part of your whole cash flow program. Look at your covenants, projecting when you're running that budget. I know that Nancy and I and Simon constantly are working with clients to figure out what are your covenants, based on your projections and modeling, where do they work out? And if we do some of these things tax-wise, what does that impact the numbers, financial statements, and the bank covenants? We're very sensitive to that because it's like 3 different stepping stones that we're trying to move back and forth on, make sure the client doesn't bust the covenants while we're trying to save them tax dollars. And those are things that just need to be thought about also.
And I would say that, yeah. And this goes to your aversion to bad news and cash flow forecasting. The cost of capital goes up the closer you are to the need of that capital, if that makes sense. So if you kind of stick your head in the sand and wait until we get a phone call and say, I'm going to run out of cash in 60 days, we might be able to help you, but that is going to be so expensive. That capital is going to be so expensive. Whereas if it had been pre-planned, that capital could have been, acquired for you at a much lower cost to you.
And don't get us wrong, there's plenty of capital out there in the markets. It's not your typical just senior lender anymore, okay? There are a lot of different thoughts and processes and types of lenders that are non-bank banks, and all different types of capital sources are out there. That's part of our job, is to help you go through that bag of Tinker Toys and figure out how that fits together and what happens. I guess it's Legos today, huh? And I said Tinker Toys, but Legos, that you figure out how to make that work. And then just looking at entity structure. One of the key things that Nancy and I laughed about this yesterday, we looked at each other when we were looking at this. Don't put real estate in a C Corp, okay? I cannot tell you how many clients we see that those gains get captured in there. You're going to end up double taxed. Just don't let somebody do that. For those of you in the real estate business, we've had to work numerous clients out of that. You were going to say something?
Well,
yeah.
And C Corps, people are wanting to go back to C Corps, and there are only a few instances where C Corps are your answer. With the higher personal income tax rates, that people are trying to flee back to C Corps, and that is not the answer.
And it's because the tax rates are simply initially lower over there, but the downside to some of that kind of stuff, depending on where you're going, is dramatic. Okay, so it's an issue to be weighed. Looking at LLCs, and again, like we said, tax rates, and then the C Corp, there's no capital gains there, but there are other things that you need to think about as you're working through that process. And then last but not least here is just a mission statement. Going back and doing a fresh look, reviewing and updating your values, and then sharing it with management employees as to where are we going, what's our mission statement, what do we think the future holds, how's our business model changing. This all ends up being part of that. And I don't think it matters how big you are or how small you are, whether you do it on the back of a napkin or you do it in a formal process that gets published somewhere on Edgar. It's a process that everybody needs to look at each year. Things are changing too fast to not periodically touch the brakes and figure out where you are. I'm gonna let Nancy talk in just a minute about
Real fast.
things that are, we call it up in the air. These are the things that are still not determined and known yet.